The information provided here is for general informational purposes only and should not be considered an individualized recommendation or personalized investment advice. The investment strategies mentioned here may not be suitable for everyone. Each investor needs to review an investment strategy for his or her own particular situation before making any investment decisions. Investment advisory represented above and investment advisory services through Portside Wealth Group LLC and SEC-registered investment advisor. Portside Wealth Group LLC and their representatives do not provide tax or legal advice. Each firm only transacts business in states where it is properly registered or excluded or exempted from registration requirements. SEC registration does not constitute an endorsement of the firm by the Commission, nor does it indicate that the advisor referenced in this disclosure has obtained a particular level of skill or ability.
Roofers, listen up. Contracts, cash flow, chaos, and control. This is the Roofers Growth and Wealth Show. Real talk, real numbers, real roofers getting rich. You're on the Roofers Growth and Wealth Show. Stacking skills, stacking deals, stacking dough. From shingles to scale, watch your empire grow. Welcome to the Roofers Growth and Wealth Show. Let's go.
Welcome to another episode of the Roofers Growth and Wealth Show with your host, Ken Rewards. I'm here with my co-host, Scott Graves.
How's it going, everybody?
And today we're going to be doing something a little bit different. We're going to be doing a bonus episode where we're going to be covering a lot of the financial topics and products and what have you, the basics of finance that we're going to be referencing in our coming episodes. So hopefully this is helpful. You can reference back to it when you need it. And this isn't going to be the last one. I'm sure there's going to be other topics that we're going to need to cover in the future. But for right now, we're going to go ahead and give you some background, some context.
We'll call it bonus episode number one. And we're going to put it into chapters as well.
Yeah.
So that it's going to be really easy to find some of this information we're going to be talking about.
Absolutely. Absolutely. Okay. So we're going to go ahead and get started with, Scott's going to lead us off. We're going to be talking, I'm going to cover the different topics we're going to discuss today,
Yeah.
And we'll go into it.
Great.
We're going to be talking about life insurance basics. It's a tool we use all the time, not just for covering you and your loved ones if you die. There's other uses for it, but we're going to be talking about that. We're going to be talking about indexing and using a cap and a floor. We use that with various products, and it's really powerful. We'll be talking about that. We'll be talking about premium finance. It's a method a lot of business owners can utilize to be able to maintain cash flow. We'll be talking about that today.
Right.
Annuities, we'll be covering that as well today. Investing basics, and then finally, retirement planning and our philosophy around that.
Yep.
Sound good? Okay. We'll go ahead and get it started with life insurance basics. I'll turn over to you, Scott, for that.
Okay. Awesome. All right, guys. So life insurance, as Ken was saying, it's a tool, right? It's one of these investment tools. A lot of times when we talk about it, this is something that, Ken, for you, when you're, having come from a carpentry background, one of your mantras, if you will, is right tool for the right job.
Oh, yeah. Yeah.
So we've got all these tools in our toolbox or in our tool belt. And depending on what our clients need or what clients are trying to build, if you will, we'll pull the different tools out of our toolbox, to put them together in different ways to create whatever it is we're trying to create. So one of those tools is life insurance. All right. So just going to go over some of the basics. Hopefully keep this really, really simple. But I want to make sure that everybody, that we're all coming from the same, basic knowledge, if you will.
Foundational understanding. Sure.
Sure. That sounds good. All right. So I'm just going to use a whiteboard. Some of you guys are going to be listening to this. Some of you guys will be watching it. I'm going to make sure that we're explaining everything really clearly, even though we're using a visual as well. So there are essentially two different types of life insurance. Okay. There is what we call term insurance. Okay. And there's permanent insurance. Now, term insurance is a very common tool. Pretty much everybody agrees that it's a good tool to use for the purpose that it does. So term insurance, a couple things that you got to know about it though, is that term insurance is temporary. All right. It only lasts for the period of the term. So sometimes we have 10-year term, we have 15-year term, 20-year term, there's 30-year term. Sometimes the term is for the period of your employment. So if your employer has a group life insurance policy that can cover you without any medical underwriting or whatnot, that is good for the period of your employment.
And for roofing business owners, that's going to be what they're getting for their employees if they do offer kind of life insurance.
Yeah, exactly. So if you offer a group plan to your employees, that is a form of term insurance, right? So it's temporary. So essentially, in order to win, you have to die. Okay, so to win, you have to lose. So if you don't die during that period, during that term, then you've put a bunch of money into it, and you bought peace of mind, right? Which is great. I'm not downplaying that, but that's all you got. Okay. Now, because it's temporary, and interestingly enough, you might not know this, statistically, less than 2% of all term policies actually result in a death claim. Okay, so less than 2% result in a death claim. So it's very, because of that, it's really cheap. Okay, very, very inexpensive. Because it so rarely has to be paid out. But the problem is, as you get older, it gets really expensive, because the older you are, the more likely you are to die. And so it gets more and more expensive to insure you the older you get. But the good news is that it's not very expensive. You can get yourself the coverage that you need to protect yourself, protect your family, protect your business, protect your partner. If you have a partner in your business, all those things are important. Okay, but they just that is what term insurance does. Now, the other hand, we have permanent insurance. And permanent insurance is not temporary, right? It's permanent. That's what it comes from. A really common version that a lot of people are familiar with is whole life, right? Whole life insurance. And then there's another form that has become more popular recently because of its flexibility, and that's universal life. Okay. Now, the nice thing about permanent life insurance is that at some point, somebody's going to get paid. All right. So the money that you're putting into it eventually is going to lead to some type of death benefit for, for your loved ones, or for your partner, or for your business, or whatever it might be. All of which is important. So at some point, somebody's going to get paid. But that also means that it can be pretty expensive. Okay. It's not cheap. And whole life especially is kind of the most expensive version of life insurance, because everything in whole life is guaranteed. You are guaranteed a certain premium. You are guaranteed a minimum interest rate. You're guaranteed some type of a death benefit. As long as you keep paying your premium, everything is guaranteed. So that makes it expensive. Universal life is a little more flexible. You can pay more. You can pay less. You can skip payments if you want to. So it's one of the reasons why it's become a little bit more prevalent. So, but the other really cool thing about permanent insurance that really differentiates it is that it has a cash value. All right. So if you have a premium payment, a percentage of that premium payment is going towards the death benefit, right, or the statistical cost of that it costs the insurance company to insure you. So a portion of it does go to that. We call that the cost of insurance. A portion goes to that, but the rest of it goes into this cash value. And this cash value can earn interest. Okay. And it can earn interest in a number of different ways. One of them, in fact, you can even be based on market performance if you wanted to. So you can get some good growth out of this cash value. And then the interesting thing about the cash value is that it grows tax-free. Okay. So it grows with the tax, and then it can also come out tax-free, usually because we're doing what are called participating loans, right? So you are borrowing the insurance company using your cash value as collateral. Very, very expensive loan, maybe 2.5%, maybe 3% loan interest rate on that. So assuming that your permanent life insurance policy is set up correctly and is structured correctly and is maintained correctly, this tax-free benefit is pretty powerful.
So some people do use this as a vehicle for saving for retirement, for having
absolutely
a bucket of money.
Yeah, absolutely. And it doesn't have to be for retirement. This money is pretty liquid. You can access at any time, 85% of what's in this cash value. Different companies treat it differently as far as the amount that you can borrow in the loan. But you can access a pretty serious chunk of it without any tax, and you can access it whenever you want to. You can use it for retirement. You can also use it to fund purchases through your company. You can use it for, for college for your kids if you want to. There's a lot of flexibility. You can really use it for whatever you want to. There's no restrictions.
Yeah, there's a lot of tools there that, or a lot of use cases, I guess you could say, for this tool. It is very flexible. We even have at times called it, tongue in cheek, a super Roth.
Yeah,
right?
super rough.
Because some of especially some of our business owners who are listening to this are going to be high income earners, and
Right.
and oftentimes they can't really contribute to a Roth in an effective way, and so we found that they can do this instead, and it offers a lot of flexibility
Yeah,
to get
exactly.
tax-free money in retirement or even before.
Yeah, and having a tax-free asset in retirement can be a pretty powerful thing. It gives you a little more control over how much tax you're paying in retirement. You might have your tax deferred accounts like your 401k or a cash balance plan or something like that, or a SEP. But then you're going to pay taxes on everything you take out. So if you have some type of a tax-free asset like a Roth or like a permanent life insurance policy, it just gives you more control over how much taxes you're paying in retirement, which could be a pretty powerful thing.
It's great. Thanks. Okay. Well, the next thing we're going to talk about is indexing, using a cap and a floor. And you mentioned this, Scott, how in the index universal life policy, and even in the whole life policy, there's different ways these can grow your cash value, right?
Right.
One of the ones that have become very popular is what's called indexing, or using a cap and a floor on your growth every year. And this isn't the case just with life insurance, but things like annuities as well. They use something like indexing. And what that means is when you're indexing within this policy, you're not actually participating in market growth. You're not actually in the market.
Right.
Right. But you can actually participate in that market growth. And the way that works is if you do have, you're tracking an index. In an index, for those that don't know, it's a collection of a lot of stocks that give us a picture of what the market is doing as a whole, usually in a certain broad sector, or maybe even not the market entirely. One of the biggest indexes out there is the Dow Jones Industrial Average. We look at that to see what the market is doing.
Right.
S&P 500 is a pretty big one too. But we track one of these indexes. And what we do is we say, okay, if that index goes up, I can get that growth. But if it goes down, I don't lose. So the way that works is, let me go ahead and share my screen here. So when you have a cap and a floor with this index, it works somewhat like this. So as the market is doing, bear with me here, that.
We'll cut this part out.
Yeah. Okay. As the market is doing this, going up and down and up and down, this index, or this tracking the index, we're doing this indexing option, market goes up, you can go up with it. When the market goes down, we're going to not use that. Let's cut that out. Let's go back.
Okay.
That's a weird color. Yeah.
And you want to use the middle of your whiteboard.
Yeah, I'm going to get rid of this guy.
Use the X.
Just get rid of it. Yeah.
I'm still seeing you. Yeah.
Okay, good. Okay. Let's start that over. Okay, the way this indexing works is as the market is doing its up and down thing.
Right.
What you do is when the market is going up, you can go up with it. But when the market goes down, you stay right where you were and you don't lose. Again, market goes up, you can go up with it. But when the market goes down, you stay right where you were and you don't lose. Now, that sounds pretty fantastic. Let me explain a little bit more about how that works and why you'd want to use it and when you don't want to use it,
Right.
what to look out for. But you'll see a gap in the growth here. Say, for example, this first year, this gap you see, that's because of a cap, right? One of the things you got to watch out for is you have a cap or a limit on your growth. So a lot of the policies that we use right now, especially, these caps are pretty good. Interest rates are high. So these caps can be anywhere from 8% annuity up to life insurance, 12, 13%, right?
Yeah.
So that's where they are. So what that means is if the market's going up, the most you're going to get, let's say in the example of 12%, is 12%. So 12% will be your high. But it has a floor tied to it too. So in annuities, the floor will generally be 0%. In a life insurance contract, sometimes that's 2 or 3%. So your floor will be limited to that.
Right.
So if the market goes down, the worst you could ever do is that 2% in a life insurance contract. So you should be somewhere between that 2 and 12 every single year. What we found, given enough time, you'll probably end up averaging around that 6 to 7% growth in those contracts in an account that you use, which can work that's the first trade-off. You got to be okay with that cap, limit on my growth. The second trade-off you have with these kind of products that do indexing, whether you use an index universal life product or an indexed annuity product, is you got to be okay with the time frame, right? And we'll get into that a little bit more later. But this time frame means this is a time where you cannot be moving the money, majority of it anyway, outside the contract, or else you have penalties for doing so. Kind of like a lot of people are familiar with CDs and how they work. Leave my money in at the time. I'm going to get some guarantees for it. Same thing holds true here. You got to keep it in for that time frame, majority of it, in order to get these guarantees and these benefits. So as long as you're okay with those two things, indexing can be a good path for you, a good way to grow your money within some of these products.
Yeah, and just to I do also want to just reference for clarity's sake. We do what we're talking about here is indexing within some type of insurance product. Okay,
Yeah.
so a life insurance policy, an annuity. There is what we call indexing in the markets, where you can essentially invest in a way that tracks or mirrors or is very close to one of those indexes we're talking about, right? Dow Jones, S&P, that type of indexing in the market, you can lose value, but it'll track very closely to what that index does. So you can only get this floor, these caps and floors, they really only happen inside of insurance products. I mean, there are some very complicated ways you can do it in the market, outside of insurance product, but we're not going to get
It's a little bit more advanced. Yeah.
we're not getting into that type of strategy right now.
Very good. Good clarification, Scott. Okay, go ahead and tell us a little bit about premium finance.
Okay, so
Solution to put money in.
So this is an interesting one, and it's one that has some moving parts, but it can be a very, very powerful way, to do this kind of thing that we're talking about. Okay, so when it comes to premium financing, what we're talking about here is it's a solution that we use in conjunction with a life insurance policy. Okay, and it's something that not everybody's going to do. It's not going to be the right thing for everybody. It's kind of a niche strategy.
Yeah.
Okay. It does work very, very well for business owners. In order to do this, you really need to have a net worth of roughly $5 million. That can include obviously your business value, the value of any investments, your home value, right? All of those things figure into that.
Yeah.
But you really ought to have a net worth of about $5 million, an income of 250 plus, that you're showing on that either you're showing on your tax return, or we can show, in a reasonable way that that's your income. And the reason, and those requirements are because of, well, scratch that, go back. So as long as you have that net worth and income, then this could be a really powerful strategy for you.
I think there's one more thing that really is a bar. You got to make sure this is all right with you in order to contemplate using this as a strategy. And that is, how do you feel about leveraging?
That's true. Yes.
There's a lot of people out there that are very wealthy, but if you tell them, hey, do you want to take out a loan? They will put a cross in your face and say, get intense. Right. So you got to be careful there. You got to be okay with leveraging and using somebody else's money to be able to achieve some growth.
Exactly. No, it's a very good point. Okay. So for those of you who are watching this, you can see on my on my whiteboard here. So first thing we have is our investor. Okay. We have the person that we're working with, our client. Okay. That's you, for those of you who are watching. And then what we're going to do is we're going to set up a life insurance policy. And this life insurance policy, normally, you'd be putting after-tax dollars into this life insurance policy. Okay. But you as our client, you are the insured on the life insurance. Now, instead of you putting in after-tax dollars into this life insurance policy, we're going to bring in a third one. Okay. We're going to bring in a bank.
And we are diagramming this, but for those that are just listening, we're going to be explaining it pretty well too. Right. So hopefully you can follow along.
Yeah. So we're going to bring in a bank, and what we're going to do is we're going to have the bank make the premiums to the life insurance policy on your behalf. Okay, on behalf of our client. Okay, so the bank is putting in the premiums. And what you as the client are going to do is you're going to be making payments to the bank of at least the interest due for a few years. Okay. Now, keep in mind, this is a very flexible strategy. It can be set up in a million different ways. All we're showing you right now is an outline of the basic structure, but the amounts that are moving here and there and everywhere are completely, designable, and are very, very flexible. So the bank is making these premium payments to the life insurance policy for, 7 to 10 years, generally speaking. Okay. And over roughly that same time frame, you, the client, are making those same interest payments to the bank. It doesn't have to be just interest. It could be more of a flattened out type of payments to the bank. Again, very, very flat. This life insurance policy, it is a permanent life insurance policy. So as we explained before, it has a cash value inside of it. And this cash value is also earning interest. Now, after 10, 15, 20 years, and very flexible, what we're going to do is we're going to take money from that cash value. We're going to borrow money from the cash value, and we're going to pay off the bank. The loan is now done. The bank is out of the picture. And you, as the client, own that life insurance policy free and clear. Okay. Now, what this life insurance policy can do is it can pay out to you tax-free benefits. All right. So what that does is puts you in a position now as the client, the owner of this policy. You got this gigantic cash value, which is much bigger than it would be if you had been putting the premiums in yourself. Because instead of you putting in, 25, 50, maybe $100,000 a year, the bank is putting in $500, $600, $700,000 a year on your behalf. Okay. So you got this gigantic cash value in here. The bank is paid off now. They're out of the picture. Okay. But now you own all that cash value that's left in there. You're taking tax-free benefits. You can take it as income. You can take it in a lump sum. Okay. And then, of course, when you pass away, there's also a death benefit for your family. Now, a lot of this, especially for our wealthy clients who qualify or that this type of strategy fits, oftentimes they have estate planning issues. They have estate tax issues. And this death benefit from the life insurance policy, death benefit from any life insurance policy is also tax-free. So we can use this death benefit from the life insurance policy to pay any estate taxes that you might have, or rather for your family to pay whatever estate tax you might have left for them. So Uncle Sam still gets their money, but your family gets to keep what you've left for them. So it can be a pretty powerful way as well. So again, there are definitely some big pieces here. But it's a very, very flexible strategy that's very powerful for our, roofing business owner clients.
Great. Thank you. Something that really strikes me and we've found with our business owners is oftentimes they look at their cash flow and they guard that.
Right.
As they should. Business owners do. You do that.
Yeah.
And you look at every dollar going out and you go, oh my goodness, I don't want that to go out. But we look at this and realize that we need to be diversifying outside our company. I just can't afford to do it. How do I do this? And we found that this is a great way to maintain your cash flow and let the bank start funding your retirement for you.
Right.
Pretty cool.
Yeah, it's fantastic. And it's a great way to get your investment dollars working in more than one place at the same time.
Yeah.
Instead of you dumping $500,000 a year into a strategy like this, you're putting in a fifth of that or less, and the bank is doing all the work.
Yeah.
So
sure. Love it. Okay, let's go ahead and talk a little bit about annuities. Well, actually, a lot of it. We'll see how much of a bit I talk about. Cut me off if I go too long. But annuities are another tool, another area that we use for specific designs, specific needs that a client might have. Generally speaking, they come into play when we're doing retirement income planning, something like that. Annuities really have two primary fits for us. One is a bond replacer. We'll talk about that in a second. And another one is an income source in retirement, because it's one of three that guarantee an income for the rest of your life in our society. We have Social Security, we have pensions, and we have annuities.
Right.
Right. In fact, oftentimes you might have heard annuities are the worst. You shouldn't do annuities, but tell you what, your Social Security, that's an annuity. So these guaranteed sources of income, and this is actually why annuities were created in the first place. It used to be, if you remember your father, your grandfather, they were at a company for 35 years. They were entrenched in that company. They got the gold watch. They got a pension when they retired, right? Everybody had a Social Security benefit. Everybody had a pension when they retired. But companies started to realize that that was making them go bankrupt.
Yeah.
That wasn't working. There's too many people retiring, especially with the baby boomers. They saw the writing on the wall and realized, hey, we're not going to be able to do this. And these pensions, we call those defined benefit plans. They tell you up front, this is what your benefit is going to be. You work with us long enough. That's that defined benefit plan. So these companies realize, let's change this up a little bit and let's change this over to a defined contribution plan. These defined contribution plans, instead of saying this is what your benefit will be, they said, this is what we'll give you up front. We all recognize these. These are our 401ks, our 457, 403bs, these employer plans where we put money in and oftentimes they'll match. They say, we'll put some money in for free for you up front. You go, all right, that's pretty cool. But what they don't do is they don't guarantee you any kind of a benefit in the future. It all depends on how much you're putting in. It depends on what the market does and how it grows. And it depends largely on how you use it in the future, right? So one of the biggest risks in retirement and finance that exist is longevity risk.
Right.
The longer you live, the more exposure you have to all these other risks: health risk, tax risk, market risk, all these things. Inflation risk, of course. So longevity risk was taken off of the company because they gave this guaranteed income for life, and they put it on us. Said, you take care of that longevity risk. And the problem is we're living longer. We're living, and the gap between us, our age when we die and the age when we're healthy is actually getting longer too.
Yep, it's true.
So more unhealthy years. So we had to come up with a way to make sure that we're taking care of this longevity risk. Annuities was that way. So annuities is a way of you basically purchasing your own pension plan.
Right.
You put money into an insurance company, give it to this insurance company, and the insurance company will guarantee you an income for the rest of your life. That's an annuity at its most basic form, just guaranteed income. And the only reason insurance companies can do this, and they're the only ones that can do this, is because they insure the flip side of that coin. They insure the flip side of an annuity is life insurance. Right. And so when they pull in all this risk and they know, okay, if so many people are passing away earlier, then we win or we lose because we got to pay all this money up. But they figure enough people are going to live long enough that we're going to make money. Annuities are the opposite. They go, oh my goodness, if these people live forever, we're going to be paying out the nose for these guys. But if they die early, when we expect or hope they do, it's kind of sad to say hope they do, but kind of with these insurance companies, then the insurance company can win. So they play both sides of that coin. But these annuities, they really are built to do that. But there's different types of annuities out there, just like we talked about with life insurance. These annuities have various types, and these types, instead of going to the diagram, I'm just going to kind of talk through it.
Yeah.
But these different types are, you have the straight up pure annuity that just gives you an income for the rest of your life. This is called an immediate annuity. You put your money in, they start paying you. Problem with that one is you die, nothing goes to your kids, your family. It all goes to the insurance company.
Die the next day.
They keep the rest.
They keep
the rest.
Yeah.
These deferred annuities is what's more popular today. Deferred annuities is you put the money in, it grows over time, and then you can take a benefit in the future. And there's various types of these, but some are really built to give you a great income. Some are built just to grow, and then you can withdraw it as you want in the future, right? So these various types, I'm going to go into a little bit because it's important on how they grow.
Right.
Okay, so these deferred annuities, you have a fixed annuity. The fixed annuity works very similar to a CD.
Right.
They give you a guaranteed rate for a certain amount of time. Done. I walk away, I got my guarantee, everybody's happy.
Mm-hmm.
Then you have a variable annuity, where instead of a fixed rate, it is varying based on the market. You actually invest in funds within this annuity, and if the market goes up or down, you're going up or down with it. Right. These can be a little bit more expensive as well. If you have access to investments in the market, often that could be a better way to go if you want to invest in the market than using the variable annuity. But there might be a place here.
There might be a place here or there.
Might be a place here or there for it.
It's not common.
Not common.
Usually, if we're going to invest in the market, we're just going to invest in the market.
Exactly. Right tool for the right job. Right.
Exactly. Right tool for the right job.
Probably the most common annuity nowadays is what's called a fixed index annuity. And this one does indexing like we talked about earlier, where you can, market goes up, you can grow with it. Market goes down, you don't lose. A lot of people figure that's actually a great solution over time to grow my money in something like this.
Right.
And then produce an income for them. And that's another reason why this can serve as a bond replacer. So what we found is using an index annuity, if we build it right, the indexed annuities often average better growth than a bond portfolio would for you. If you were to, often people when they invest, they'll put some money into stocks and some into bonds. I want some at risk and some safe. And if we just replace those bonds with the annuity, we can get better growth with guaranteed safety. It can raise the overall performance and efficiency of your portfolio.
Yeah,
that's what we find with these
For
annuities. Sure. And so, annuities in general can be a good tool. They're not for everybody. It's usually for your older people, but that are getting ready for retirement. But as a bond replacer, they can still serve purpose too.
Yeah, for sure. And as long as the time frame. Remember, we talked about the time frames on the indexing strategies. As long as the time frame works, it's an excellent bond replacement.
Yep.
Yeah, excellent bond replacement.
Okay, next we're going to be talking about investment basics. Scott, go ahead.
Okay, so when it comes to investment basics, there are a lot of things. We have clients come to us all the time, some of whom are very, very knowledgeable about investing, some of whom have no idea, have kind of sort of been investing for a while, but don't really know what
in their 401k, stuff like that. Sure.
Right. In a 401k or whatnot. And so, but it's pretty common that people don't have a whole lot of information about, what the heck is going on in there. And so we thought it'd be helpful to show a couple of ways that, just basic details about investing so that you can, even if you never work with us, at least a little bit of information about, how this all works.
Mm-hmm.
So some of our clients come to us very, very savvy with investing. They know a lot about how to do that, what's going on. A lot of our clients are busy running their businesses. They know that part and they're great at it. And for a little bit of help, but we felt like it would be a good idea to make sure that all of you guys out there have some basic understanding of how the market works and what the market, just some details so that when we have these conversations, you can come into it with some basic background knowledge. So I'm going to share my screen again. And we're going to be looking at a couple of different concepts. So the first thing we're going to talk about is the difference between stocks and bonds. A lot of times when we're investing, we talk about investing in stocks. Those are sometimes called equities. Or we might talk about investing in bonds, which are sometimes called fixed income. So when we're talking about stocks, what a stock is when you invest in a company, is you actually own a small piece of that company. Usually a very, very, very small piece of that company. Companies will issue a certain number of shares. Let's say make it really basic, 100 shares. That means that if you own one stock, then you own a piece of that company. You own 1% of that company. Okay. Now, the fact is about that most companies, when they issue stock, they're issuing it in the millions. And so that's what's called your outstanding stock. So you own a very, very small percentage of the company. As an owner in the company, technically, you have the ability to vote on certain actions that the company takes, like who the board members are going to be, whether the board should fire the current president of the company, CEO of the company, and hire somebody else. So you have a certain amount of power, a very, very small amount of power usually, when you own stock in a company. If you own as much as, but having that right to vote is important. And so you'll often get letters in the mail when you own stock in a company that says, "Hey, we're having our stockholders meeting. It's at this date and it's at this date, this time, and this place." And you can go and you can show up in person and vote in person. Most people don't do that. Most people will do what's called a proxy vote, which essentially means that you are turning over your right to vote to board members. Um, and a lot of people, that's fine. They don't really care. They're not really that interested. But you do have the right to go and vote technically on things that the board of directors does. So that's what a stock is. Another thing that will happen with some types of stock is that um, you will receive dividend. You could potentially receive a dividend from the company, which means that they are taking their profits and they're sharing them with their stockholders. All right. So let's stay on this topic of stocks for just a second. I want to introduce a concept called the Morningstar Grid. So the Morningstar Grid is there's a company. The company Morningstar is a company that analyzes stocks, analyzes mutual funds, and classifies them to help people understand what they're investing in. They developed something called the Morningstar Grid. Morningstar Grid is essentially made up of 9 boxes. And the 9 boxes place, on one axis, on the left axis, you have large cap, you have mid cap, and you have small cap. Cap is short for capitalization, which is a representation of how big the company is. Large cap is big companies, mid cap, medium sized companies, small cap, small companies. Now, the axis across the top is what we call value companies on the left side. On the right side, you have growth companies. And in the middle, you have core or blend. It's kind of companies that don't fit into either the value or the growth categories really clearly. And so they kind of put them in the middle. The value companies are companies that have been around for forever. They're very, very stable. They do one thing, they do it really, really well. And that's all they do. That's what they are. So we're talking about companies like Coca-Cola, McDonald's, GE, Corning, which of course makes glassware. So there are a lot of these companies that GM, okay, car companies. These are companies that this is what they do, and they do it really, really well. So they don't grow a ton. You'll see their stock, generally speaking, their stock is going to increase a little bit over time, gradually. All right. And so we would see them placed into the large cap value part of the grid. On the other hand, we have growth companies, which are large cap growth companies. These are innovative companies that are coming out with new widgets or new technology or new ways of doing things. And so they are in growth mode. So examples of these companies would be Netflix, Microsoft, Apple, Google, NVIDIA, Taiwan Semiconductors. Those are all the technology companies. You also have pharmaceutical companies that are coming out with new like Pfizer, new vaccinations or whatever it might be. So these are all growth style companies. They have a tendency to grow, can grow very quickly, but they can also lose value very quickly. So they'll be up and down, much more volatile than your large cap value stocks. So your most conservative stocks are your large cap value stocks, very big established companies, and they're very consistent in what they do. The most aggressive stocks would be your small cap growth stocks because they're small companies. They can go out of business, but they're also in growth mode. So within that framework, there's all kinds of different types of companies, and you'll see on the Morningstar Grid, they can be placed in all kinds of different places: mid caps, small caps, value, growth, core, whatever it might be. So that's the Morningstar Grid. A lot of time, very, very frequently, we talk about stocks in these terms. All right, is it a large cap value stock? Is it a small cap growth stock? So that's what the Morningstar Grid is. It's a very quick, handy shorthand for understanding how stocks work and how different companies are classified. Mutual funds will also often be classified in this way. Maybe it's a mutual fund that focuses in on large cap growth companies, or it focuses on mid cap value companies. So when you see those names on mutual funds, you know more or less what you're getting. Now, let's talk about bonds for a second next. Bonds I'm going to just erase everything that we just put on this white screen, but on this whiteboard. But bonds are you don't actually own a piece of the company when you buy a bond, whether it's from a corporation, the federal government, uh, a municipality. What you're actually doing is you are loaning them money. So let's say you loan a school district $1,000. And let's say that, and what you're promising to do is you're loaning them money for a certain number of years. Let's say, in an example, it's for 5 years. Well, that means that you're loaning them that $1,000 for 5 years. They're going to pay you an interest rate on that money every year. Usually it's quarterly, actually. But they'll take that interest rate and they're going to split it into 4 pieces. They'll pay you quarterly. They're going to pay you that for 5 years. And at the end of the 5 years, they're going to give you back your $1,000. So because of these contractual arrangements, bonds are much more stable, far less risky than stocks. They can still go up and down in value, but usually less so than stocks. So if you have $1,000, I'll just draw a quick example on the whiteboard here. $1,000, and let's say the coupon rate or the interest rate that they're going to pay you is 10%. Now, there are not a lot of bonds out there that actually pay 10%, but it makes the math easy. So let's say in the first year, on paper, the value of the bond goes down. Maybe stocks are really, are looking really good. And so lots of people are buying stocks, fewer people want to buy bonds. And so value on paper is down. That can happen. Okay. So let's say it goes down to $900. So if you sold it right now, you would sell it for $900. In the meantime, however, the company is giving you $100 because that 10% is based on the original $1,000 that you loaned to them. Then let's say in the second year, it goes up. Maybe stocks crash. So everybody's running to buy bonds. So your bond is really attractive. Let's say it goes up to, $1,050. So if you sold it right now, you can sell it at a little bit of profit. But in the meantime, again, the school district is paying you $100 in interest. Well, in the next year, let's say that interest rates go up. When interest rates go up, maybe the new interest rates are now paying 11% or 12%. So your bond isn't as exciting. So maybe it goes down to now maybe it's only $950. Okay. So, but in the meantime, again, you get the same $100 interest payment. Let's say in the fourth year, it goes up again, interest rates fall. So now maybe new interest rates are only paying 9%. Yours pays 10. So somebody might be interested in buying yours. So let's say it goes up to $1,100. Okay. Again, sell it at a profit. Again, the school district pays you $100. In the last year before it matures, this is the maturity date at the end of the 5 years, it must go back to its original $1,000. Why? Because nobody's going to buy that thing for more than $1,000 from you when they're only going to get $1,000 in a couple weeks. And on the flip side, you're not going to sell it for less than $1,000 when you're about to get $1,000 back. So market forces say it must go back to its original $1,000. So when you, at the end of that 5 years, you're getting $1,000 back. Again, the insurance or the school district pays you $100. So you essentially, if you hold the bond all the way to maturity, you got your $1,000 back, plus you got $500 in interest. All right. So that's what bonds are a lot less risky than stocks are, but they can absolutely still lose value.
If you sell them before their term ends.
If you sell them before the term ends. Sometimes you can get profit too, but it just depends on what your goal is for that particular bond. Now, a bond fund, if you're buying bonds as part of a mutual fund, you have no control over when those are bought and sold. You don't really have, you get what you get. But that's essentially how a bond works. So stocks, you own you own a piece of the company. Bonds, you are loaning money to the company or the municipality or whatever. And so talking about it, just hopefully that gives a little bit of clarity on how those things work.
Fantastic. And when we're putting together portfolios for clients, we use all sorts of tools here,
right.
Different types of stocks in different sectors of the market and different parts of that grid, as well as bonds of different types, all to accomplish specific things, including what kind of risk you want to take.
Yeah, exactly.
Right. Yeah. But these are the tools that we use.
The tools we use.
Best. Very good. Okay. The last thing we're going to discuss today is our planning framework, what we do. Now, we do plan with our clients, and in that plan, we take into account all these tools that we've been talking about, sometimes more. We kept things basic today, but we are going to discuss what that planning framework looks like. So the framework we use is something we call paychecks, playchecks. Now that is not our term. That's actually something that's coined by a very smart man in our industry called Tom Hegna.
Yep.
He is an expert in retirement and the tools that we use for retirement, that kind of stuff. But paychecks and playchecks, we feel like really encapsulates well what we do with our clients. So the way we do this is our first step is we're looking at making sure that you're taken care of, right? First thing we want to do in that is we have these two umbrellas, right? And on the left side, we have paychecks. On the right side, we have playchecks. Important piece here to understand when we're putting a plan together for somebody moving into retirement, looking at retirement, whatever that might be, is we got to understand our psychology. Our whole life programs run off paychecks. We get a paycheck from our employer. We get paychecks month to month, and we're okay spending that. We have no problem spending that because the paycheck is coming next month. The problem that we've found a lot of times is when people get to retirement, all of a sudden they have to use their own money. Instead of the paycheck, they're using their own savings. And that freaks people out. No matter how much money they have, it freaks them out. So we got to make sure paychecks still come in. So when we're putting this together, the first step, we look at your expenses. I forgot the X, didn't I? So your expenses are really your month. What's going to make sure that you can continue to live the life that you've been living and keep yourself comfortable? Things you can't do without. Now, everybody's different. Some people say my expenses are the bare minimum. Some people say I cannot live without that trip to the Bahamas every year. And I want that part of my standard expenses. Okay, whatever it is, that make sure that you live comfortably the rest of your life. We take those expenses into account. Now, it's a pretty simple math problem. In today's dollars, we find out what is that? What are you currently paying for that life? And we find out what that dollar amount is. What we have to do from there is we have to add inflation on top of that because things are going to get more expensive as we move forward, aren't they? Once we figure that out, what we know from all the studies out there from the experts and what they've said is that to create the life that people look for, to have the least amount of stress, the most amount of peace, the most amount of fulfillment in their life and in retirement especially, is this section here. These expenses have to be covered by guaranteed income sources. I don't want to have to worry about whether or not it's going to be there if we invade Iran or if they close the Strait of Hormuz, right? I want to make sure it's always going to be there. So there's only three, and we talked about this before, but there are three sources of guaranteed income in our economy. Number one is Social Security. Now, you might argue with me about that, but let's just say for argument's sake that Social Security is always going to be there. Another one is pensions. Now, not a lot of people have those anymore, but pensions are another source. We look at those two, and we decide, okay, is that going to cover the nut? Is that going to cover everything we need? No? Yes? Okay. If it's not, we got to move on to number three. And number three is the annuities that we discussed earlier. Remember that annuities are basically a private pension. You can purchase your own pension, create a guaranteed income source in retirement, right? And we can make sure that that takes care of your expenses, your paychecks, plus inflation as well moving forward. Right? Now that that's taken care of, all of a sudden, when we have these years where the market's going up and down and up and down, what we've seen in the past, in this down year, when people have all their money in this red line, this up and down, you know what they stop doing? Spending money. They start eating ramen. They stop traveling. They stop doing all the things that they would normally do. All their money's coming from this market. But if we can make sure this plan is put together, that the guaranteed income sources are taken care of, all of a sudden what happens when this red is going on, people don't worry. They stop fretting about it. So we can move on to step number two without the stress. So step number two is paychecks. And this is your fun. This is the extras. This is everything else. Okay. And the lifestyle stuff. And this is, I want to buy the truck maybe a couple of years from now. I want to add on to my home and build that extra bedroom or remodel my bathroom. These are the things that we don't need to do every month and every year. And over here, we can use things like stocks and bonds and mutual funds and real estate and so on and so forth. Some people might argue with me and say, hey, real estate, I have these properties that give me an income every month. Well, let me ask you a question. I felt the same way. But what happened in 2020?
Right.
We couldn't evict, and they didn't have to pay.
Right. Yeah.
So it's something that we always count on? Not necessarily. Can it be a good source of income? Sure, absolutely, but not a guaranteed one. So that's why we put it over here on the fun and extra side. But all of a sudden, we can be a bit more strategic here. We can grow these a little bit more aggressively, and we can watch them and say, have these lost a lot? Let's not take money from that one. This other one, gain. Let's go ahead and take money from that to pay for your truck. We can be a little bit more strategic on that side. And once we have these paychecks and playchecks in place, best laid plans, right? Who was it that said everybody ended they get punched in the face? Mike Tyson, right? Okay. So, yeah, something like that. And in a different voice. I can't do the Mike Tyson voice. I'm not going to try. But we have to protect this plan. And one of the biggest things that can come in and throw this plan off is long-term care expenses. The statistics shows that more than 2/3 of people over 60 years old is going to need some kind of long-term care in their life, right? So we got to make sure it's planned for. It doesn't mean you always have long-term care insurance, but we need to talk about it. What are we going to use? How are we going to use it? When are we going to use it? Do you want to be taken care of at home? Do you want to be taken care of in a home, outside your, right, in a facility? So we got to take a look at what that looks like and make sure a plan's in place. So that's number 3. Once that's done, all we have to do then is talk about, all right, where's this money going in the end? So this is legacy planning. This is my favorite part. This kind of bookends our conversation. Because when I say legacy, most people think, when we say legacy, most people do think, how is my money going to go to my kids, or how's it going to go to the charities, all these dollars and cents. But I've told people before, when my dad leaves us and we're looking at his legacy, I'm not going to a $1 bill that he gave me and be like, I remember Dad. But that's not the legacy. The legacy is what kind of imprint do we make in the world? What did we do for the world? How do people remember us? And so once we have this plan put together, it's no longer I'll wait till someday when I retire, I'll finally. When I die, maybe it'll go on. No longer. Once this plan is in place, we can start to look at that paycheck side and say, how do we put that to use now to create this legacy? I think that's powerful. Right in our solution, what we do. So that's step number 4. Not just talking about what happens when you die, but more importantly, what you do now that the plan's in place. So that's what we do. It builds obviously off of Tom Hegna's paychecks and playchecks. It's a little bit beyond, but that is the foundation, obviously, from what we have there.
Love it.
Anything you want to add to that, Scott?
I don't think so. I think that, the whole idea of having a good financial plan is to live your life now. To live your life in an effective and a meaningful way, in a way that really that fills your cup. That helps you to feel successful, to do the things that spend time with the people you want to spend time with, and make sure that the way you're spending your time is what gives you a reason to get up out of bed in the morning.
Yeah.
Besides just grinding. Yeah. Grinding is great. We want to grind, but every once in a while we got to unstring the bow, and make sure that we're spending the time doing the things that we love.
Yeah, got to have a game plan. Love it. Okay, well, thanks, guys. I know we went through a lot today, and I hope you enjoyed listening to this. Hope you got something out of it. If you got one nugget, if you learned one thing, fantastic. But hopefully this gives you a little bit better context on our future episodes, and because we'll be mentioning things like this index universal life, or an annuity, or a stock, or a bond. And we hope that you understand a little bit better about what we're talking about. And of course, we're going to have some additional bonus episodes to go a little bit further in depth on some things. But that's our episode for today. Thanks for joining us, and we'll see you next time.